Here's a number that should change how you invest. Since 1926, just 4% of stocks have created almost all the wealth in the entire US market. This is every dollar of profit above a basic savings account out of nearly 29,000 companies. 4%. And the other 96, as a group, they did almost nothing. And in fact, more than half of all stocks, over 14,000 of them, actually lost money. Yet, over that same century, the market as a whole made patient investors wealthy. How? Because a tiny handful of winners carried everything. But what's important to remember? Almost no one in advance can tell you which ones. Not the star managers, and not their funds charging you a premium to try. That one fact quietly explains why most beat the market promises let you down. So in this video, I'll show you a calmer, evidence-based way to invest. And by the end, you'll stop staring at individual trees and finally see the forest as a whole. Let's start by cutting through the noise. Underneath all the jargon, there's really only two ways to invest. The first is to look like the market. This means you own a small slice of nearly every company, roughly in proportion to its size, and you simply capture what the market delivers. The logic here is powerful, and at any moment, millions of buyers and sellers with the same information are setting prices together. Those prices aren't perfect, but they are fair. And they already reflect what the crowd collectively knows, so rather than trying to outsmart everyone, you ride along with them. The second way is to not look like the market, to be deliberately different. Own more of some things, less of others, or jump in and out at the right time. This is called active investing, and the only way it can beat the markets is by betting against it. Now, when we're talking about the right way to invest, there's an important point I want to make because it gets easily confused in this conversation. We need active investors. Their constant research, buying and selling is exactly what keeps prices fair in the first place. That process even has a name, and it's called price discovery. So when I compare active and passive, I'm not saying active managers are foolish or that their work has no value. The whole system depends on them. The question we're going to talk about is more narrow and much more personal. It's about which bet is the right move for your money, for the dollars that you've sacrificed to save. Now, let's look at the evidence because it's remarkably clear. Remember that 4%? Let me show you why it's the most important number in investing and why it makes beating the market so brutally hard. The research comes from a finance professor named Hendrik Bessenbinder, who studied nearly a century of stock market returns across nearly 29,000 stocks. 4% of companies produce the market's entire net wealth. 4% of trees produce the whole forest growth. The other 96% together roughly canceled out. Now think about anyone trying to beat the market. To win, it's not just about being good. You have to own those rare giants before the rest of the world knows they're giants, while dodging the huge crowd that goes almost nowhere. Miss a few of the winners, and it's not just earning the market's return minus a little bit. You can miss most of that return entirely. This is why I keep coming back to the analogy of the forest. When you handpick a few trees, you're betting you can spot future giants that even the experts miss. But when you own the whole forest, you're guaranteed to own every one of these winners automatically. No genius required. So that's a theory. Now, let's check it against reality because there's an actual scoreboard. Every year, Standard & Poor's or S&P publishes a report card comparing professional active funds against a plain benchmark they're trying to beat. It's called the Spiver Report, and it's been running for about 25 years. Let's start with the most recent year. In 2025, 79% of active large company U.S. stock funds lost to the S&P 500. Over the 20 years ending in 2025, about 93% of the best fund managers in the world underperformed the market. Flip it around, only 7 out of every 100 actually ended up beating the market. And it's actually worse than it looks because they only counted the funds that survived. Over those 20 years, only 1/3 of those funds even made it to the finish line. The rest were shut down or merged away, usually for bad performance. So that means the menu of active funds that you have to choose from today have already been quietly cleared of most of its failures. And even the survivors have mostly lost. So you might be asking, why are the odds so lopsided year after year? It's not about bad luck, it's simple math. And once you see it, you can't unsee it. There was a Nobel Prize winner named William Sharpe who explained it in one clean idea. Picture the entire market's return as a single pie. Every investor added together owns the whole pie. So before cost, the average active dollar and the average passive dollar earn the very same return. They have to, because together they make up the entire market. But here's a catch. Active investing costs far more to run. Research teams, higher fees in general. Every one of these costs is a bite out of your slice. So the idea is after costs, the average active dollar simply must come up short, not because these managers aren't brilliant, many of them are, but because you can't beat the average when you're the one paying the toll. And these costs feel tiny, which is exactly why they're dangerous. Watch what a difference in just 1% in fees does over time. If you have $100,000 invested over 30 years, at 7% a year, you'll have $761,000. At 6% a year, you'll have $574,000. Same money, same 30 years, that 1 percentage point costs you about $187,000, which is more than your entire original investment, gone to fees that you barely noticed. So I hope the picture that I'm painting here is pretty clear. If you bet against the market, the odds are stacked against you, the scoreboard proves it, and the math guarantees it. The winning move isn't picking the right trees, it's owning the whole forest as cheaply as possible. But owning the whole market is only half the job. The other half is where you finally take control, and is the part almost no one explains well. Now we know you can't control what stocks win, and you can't control what the market does next year, but you can control the single most important decision in investing, and that's your asset mix, how much you hold in stocks versus bonds. Your asset mix acts as a dial on your investment portfolio. That dial does two things at once. It dictates how much your money is likely to grow and how rough the ride feels along the way. When you turn that dial towards stocks, you raise your expected long-term return, but you also raise the size of the drops you'll have to sit through. Turn it towards bonds, the ride gets calmer, but your expected return comes down. In the 2008 financial crisis, a 100% stock portfolio nearly halved, which meant it was down nearly 50% at the bottom. A 60-40 mix, which is 60% stocks and 40% bonds, fell far less, roughly 30%, and recovered much sooner. Now, here's what you need to understand. Neither is right or wrong. The right mix is simply one that you can genuinely live through the scary days, the ugly months, and the years that the news screams at you telling you to sell. Because here's the part that matters most. The market's return only shows up for people who stay in their seat. Morningstar studies this every year and finds that the average investor earns more than a full percent less per year than the very funds that they own, purely from buying and selling at the wrong time, especially in emotional moments. That performance gap isn't a market problem. It's an investor discipline problem. That's why it's about intentionally setting your asset mix matched to the bumps that you can actually tolerate, so that when the hard times come, and they will, you don't bail at the bottom. Owning the forest earns you the growth. Choosing your mix is what lets you hold on long enough to actually receive it. And this is where it stops being about investing and starts being about your life. Because in the end, you're not doing this to beat a benchmark. You're doing it to answer 3 questions that will shape the rest of your life. When can I stop working? How much can I safely spend? And will my money outlast me? The answer to every one of those questions depends on a single number. Having a reasonable, reliable estimate of what your money will earn over time, that number is the foundation for what your future stands on. So that's why the point of this video is to help you look at those 2 paths honestly. One path bets your future in landing in that lucky 7% with a 2 in 3 chance the fund doesn't even survive. The other path owns a whole global market in the most cost-effective way possible. It hands you an expected return grounded in a century of evidence and a level of ups and downs you decide you can handle well in advance. Now, I want to end on one more important point. You can build a version of this yourself, but this is also exactly where the right kind of advisor earns their place, and it's worth knowing the difference. Most of the industry sells the expensive path, the high fee, bet against the market products wrapped in a confident story. That's the path the evidence just warned you about. The kind of advisor worth having does the opposite. They build on this evidence. They own the whole market, keep costs low, help you choose your mix with intention, and then they do the part that no chart can. They connect it to your actual life, your goals, your taxes, your timeline, your family, and which mix truly fits you. And for the fees that you pay for them, it's about, are they properly implementing all of these best practices and allowing you to stay calm, especially when markets get ugly, and adjusting when your real life changes. So here's the whole picture start to finish. Most stocks go nowhere, a rare few carry everything, and no one can pick them in advance. Betting against the market loses far more than it wins, and the math makes sure of it. So you stop chasing those trees and you own the entire forest. Then you set your asset mix to a ride that you can actually stay on, because staying on it is what turns a reasonable return into a real one. And that real return is a future that you can count on. If I leave you with anything, I hope it's this. You worked hard for your savings, and you gave up things today to build something for tomorrow. That sacrifice doesn't deserve a guest dressed up as a strategy. It deserves a process grounded in evidence, built for the long run, and pointed squarely at your life. If this gave you a clear way to think about your money, please hit that like and subscribe button. And if you'd like to look at how your own portfolio and plan looks through this lens, my link is in the description. Until the next one.